So in this video, we're going to drill down a little bit into the mechanics of mortgage-backed securities and securitization. So if you watch the video on commercial real estate finance, you'll have maybe gotten a glimpse of the commercial mortgage-backed securities. So the residential mortgage-backed securities is a very similar process, and the securitization transaction is virtually the same. It's just the type of asset that is going to get pulled together is different. Okay, so let's just step back and just review what a securitization transaction is. So we'll start here with the bank. Okay, so the bank and you, okay, as the homeowner, are going to basically enter into a transaction where the bank is going to give you money to buy your house, and in exchange you are going to execute this kind of loan agreement, and that loan agreement is going to be coupled with a mortgage that is secured by your house, so that if you stop paying, the bank can kind of foreclose and collect its debt by trying to sell your house. Okay, so that's kind of the agreement you've entered into. And so this is the kind of primary mortgage market. This is primary. And so typically this mortgage is going to be 15 years or 30 years. It's a very long-term loan. And the bank may choose to hold that loan and collect your payments every month for 15 or 30 years. But the more likely case, the system that we have in the US for mortgage finance, most banks will not really retain many of the mortgages that they originate. Okay, so the bank is the kind of loan originator. What they're going to do is go to the secondary mortgage market. Okay, so this is the secondary market. So what they'll do is take your mortgage here. This is the mortgage that they just made to you, and they're going to sell it to the GSEs. So we have Ginnie Mae, Fannie Mae, Freddie Mac. These GSEs are the largest kind of buyers in the secondary mortgage market. And what these entities are going to do is give the bank the money that was kind of lent out. So let's say we had a $300,000 mortgage. The investor in the secondary mortgage market, meaning these GSEs, are going to give you, just to keep the number simple, 300K. Okay, so now the bank is kind of in the same spot as it was before making this loan. They have this 300K back. They gave it to you for you to buy your house, but then they sold the mortgage and got that 300K back. Now the bank is happy to do this because they had made a bunch of fees off of when they first kind of gave you that mortgage. They're going to collect a fee for continuing to collect your payment and kind of dealing with you. If anything, they're going to be the servicer for the mortgage. Okay. So they're going to collect a fee for doing that for whatever, 15 or 30 years. But now they can take this 300K and go give it out to someone else and collect another fee and collect more kind of servicing fee income. Okay. So they're happy to just make that fee for being the mortgage originator because it's quite profitable. Now, Freddie Mac, Fannie Mae, they now have your mortgage, and they are also not going to just wait around for 15 or 30 years to collect your payments, because now the way it's going to work is you every month are going to pay your bank that first kind of gave you that mortgage. The bank, now that they sold the mortgage, are just going to pass it through to the new owner, okay? Because they technically don't own that mortgage. They're just kind of passing through the cash that you're giving the bank, and they're just going to pay it forward to the actual owner, okay? So now, like a game of hot potatoes, Freddie Mac, Fannie Mae are also going to pass your mortgage off into a mortgage pool. Okay, so we basically, these mortgage pools are set up as trusts. Okay, so there's a separate legal entity, a trust, and so the GSEs will sell the mortgage essentially, just like they had bought the mortgage from the bank. They are now going to be the sellers, and they're going to sell your mortgage into this mortgage pool. Okay, so who is the buyer of this? Where's the money coming from to pay Freddie Mac, Fannie Mae? What they're going to do is basically sell bonds this trust is going to sell these bonds. So this money is going to come in and from investors, enter into this trust. That money is going to be used to basically pay Freddie Mac and Fannie Mae. Maybe they're going to get their 300K back. And this 300K is going to come from these investors. So who are these investors? Well, the biggest investors are banks. Okay, so the bank essentially gave out the loan initially, and it's going to end up being the investor on the other end. Now, what is the benefit for the bank to do that? Well, Fannie Mae and Freddie Mac, what they do is guarantee all the mortgages in this mortgage pool. Okay, so they say if there's any loss, then we, as this MBS issuer, will make up any of the losses. Okay, so if you, as an individual, stop paying your $300,000 mortgage, and let's say they foreclose and they're only able to collect 250,000, this issuer, Fannie Mae, Freddie Mac, will make up that $50,000 loss. They'll out of their own pockets, they'll give the bondholders 50,000 and make them whole. So there's no real uh, risk of loss of principal on these mortgage bonds. Okay, so the banks eventually on this end here, they're going to take the risk because they own the mortgage. Okay, but by passing the mortgage through to here, and then having the mortgage go to the mortgage pool, and then them buying the bond, it's now has the guarantee. Okay, so it's the same mortgage, but now it's guaranteed. And Freddie Mac and Fannie Mae, they are essentially guaranteed by the government. Okay, so our federal government is kind of the ultimate backstop for this whole kind of system. Okay, so what was once a risky kind of mortgage because they're kind of taking the risk on you, when the bank kind of ends up here, they are now kind of just taking the risk of the federal government. The federal government is now taking the risk on you as a homeowner because any loss that's incurred, the federal government's going to make up. Okay. So the bank is happy because now they've traded the risk of you for the risk of the federal government. Okay. Through this system. So the banks are the largest investors in mortgage-backed securities. This is a kind of recent phenomenon. The second largest is the Federal Reserve Bank. Okay, so this 2.5 trillion is just newly created money. Okay, the Federal Reserve, uh, after the financial crisis, has more directly been intervening in the mortgage market by just buying these bonds. Okay, because in order for this system to work, you have this money coming into the system from investors. So a lot of this money now is just printed money from the Fed. Okay, the 2.5 trillion. And so that is kind of keeping this mortgage market functioning. Okay, because that new money from the Fed is going to eventually end up with the banks, who can then give out new mortgages. So that keeps the mortgage market functioning, liquid. It keeps the cost of borrowing down by injecting this 2.5 trillion. Now, it has the effect of potentially inflating the value of real estate. So that's good if you already own real estate. But for younger people, they don't like that because it's harder to buy a house when the prices of housing is higher, and that's been a big problem in the country. So you could potentially, as a young person, not like this policy of the Federal Reserve creating so much new money and putting it into the mortgage market. It's not good for younger people, you could argue. Foreign investors are the third largest kind of holders of mortgage-backed securities. So this is like the Japanese government, the Chinese government, Saudi Arabia. A lot of foreign investors are buying these bonds too. And so just the final note on the GSEs kind of role in this whole market, the 30-year mortgage, the 15-year mortgage probably too, would not exist at the scale that they do without the guarantee of Fannie Mae and Freddie Mac. Okay, so these entities, by providing this guarantee, are making those mortgages possible. If you just had no government intervention, uh, the 30-year mortgage would probably be a very rare type of mortgage. And you, as a homeowner or a potential homeowner, would have to uh, deal with a much shorter term mortgage and a much larger payment because, again, spreading your mortgage out over 30 years lowers the monthly payment because you have much longer time to pay back the principal. If you only had a 10-year mortgage, your payment for the same amount of loan is going to be much, much higher. And so you probably have to just save up for a much longer period of time and put more money down because you wouldn't be able to afford the monthly payments for a 10-year mortgage. So, the rationale of the mortgage of the GSEs was to make loans available for more people, but over the long run, you could argue that they have basically caused housing prices to just be much higher than they would have been otherwise. And so we'll talk about these trade-offs more in another video.